and then depreciation comes back to 100%, and now they're out looking for highly leveraged investment opportunities where they can get the most depreciation again. And I think if you don't learn from some of the mistakes, it's the definition of insanity.
Hey everybody, welcome to Season 2 of Wealth Unfiltered. I'm Samantha Parinello, and I am so happy to be back. I am here with my resident guest expert and my husband, Chris Parinello. Welcome back to the show.
Thanks so much.
I'm excited to have him here. For those of you who don't remember who Chris is, he is the VP of Investor Relations for Viking Capital, and he happens to know a lot about multifamily and investing in general. As we get started, we're going to unpack what we saw unfold over the summer and really over the last 3 months that we took a break from recording. And there was a lot to unpack here because we saw the big, beautiful bill get passed, which, had a lot of ups and downs, but definitely impacted tax deductions surrounding multifamily. We also saw inflation statistics and multifamily dynamics change and evolve. We want to unpack all of it. And who better to help me with all of this than Chris? So I'm going to start with, you've been on several phone calls with investors throughout the summer, but, even most recently, you're hearing what's next, with all of these changes, what can we expect and how do we change our strategy based off of the current environment? So one thing that we noticed is that there has been a big shift in the administration. So we saw that there was a big firing that was very controversial. And the chair, what was it called? She is the head of Bureau and Labor Statistics, who was working alongside Jerome Powell. And basically, she was fired because President Trump doesn't agree with the numbers or the way that things were unfolding as far as getting the numbers. And so I really would like you to help unpack what happened, as well as how is investor sentiment changing and the market reacting to that.
Yeah, of course. I mean, there's an old adage that stats don't lie, statisticians do. The thing is that I think that they came at her kind of like a hit squad. I think Donald Trump, regardless of who was there or what they were doing, this was something that he was able to create and affect change and put pressure on the Fed. That being said, a lot of trusted economists that I follow, things that I read, and just using common sense, thinking about the way that these stats are derived, the system probably needed pretty healthy reform. The way that they go about collecting this data is through surveys, and surveys that are, like, in many cases, just mailed to companies without clear dates of when they need to be returned. Like, you would think that since so much monetary policy is built off of this data, and the Fed is insistent on following the data, that there would be penalties for companies not reporting. Maybe they pay a higher tax, or there's some sort of mechanism to where if you don't properly report or you lie about what you're reporting, that there's a penalty, or a clear timeline of, like, we're going to send this to you, and for every company that doesn't send this in with accurate data, we're not going to allow you to file your tax return, or something. There's things that they could put in, levers that they could put in to ensure that the data is clean as possible and that they get it in a timely manner. So the big focus, and I think what everyone is kind of upset about, is investors around the U.S. are desperately wanting some relief when it comes to interest rates.
Absolutely.
Homeowners, future homeowners, people that have credit cards, like, everyone's livelihood is kind of tied to this really high cost environment we're in. And the Fed is saying, well, things look so strong that we're not going to cut. Now, if that is true and the data is accurate, then I think then it's admirable, and I would agree. Don't cut. Like, you need to see more pressure in the economy. But I think the problem that people have, from institutions to your everyday investor to people that aren't even wealthy enough to be thinking about investing, is the reality of the situation is when you go outside, you go to the store, things cost more money, things are harder. It's not as easier. You don't feel like your money goes as far. So I think that there's a lot of pressure towards really cleaning up that data. And I'm hopeful that some of this, even if it was, feel like a little bit targeted, leads to a better system.
You've talked a lot with investors, since this had happened. What is like the common denominator or like consensus of how people are feeling about the firing, but also kind of where that has taken us.
Yeah, I think that most people, industry folks that I know and I chat with and, investors that I chat with, most people believe in the thesis that, we kind of set out with 6 months ago, which was it was going to be very hard for the Fed to cut rates this year. We didn't think that there were going to be as many cuts as were baked in. And on the flip side of that, the administration really wants lower rates. So there are going to be different mechanisms that they could push in order to provoke or to try to get rate cuts. Now, what most folks that I talk to also understand is there is a timeline where Jerome Powell is going to have power over this. And we know that Donald Trump's going to get to pick a new Fed chair, and everyone I talk to believes that he's not going to pick somebody that doesn't give some immediate relief.
Yeah.
So I think a lot of things are kind of baking into that. Now, the catalyst for the firing was massive revisions. And I think those massive revisions in themselves at least have the market baking in a rate cut next month.
Right.
Will that happen? I don't really know. I think that, I was listening to a news show earlier this week, and they were pretty poignant about Powell doesn't really have anything to lose. And he kind of runs this process, even though there's other governors that get to vote. And he's going to be really focused on legacy. He doesn't want to be known as the Fed chair that let inflation back in, which I understand those kind of ebbs and flows. I think the one thing that is consistent with the Fed is they're usually late to the party because they're so reliant on data, and data lags.
Right.
So it's almost inevitable that they're going to be late. So I'd like to see them be a little bit more aggressive, not too aggressive, but maybe 50 basis points by the end of the year, and maybe another 50 basis points over the first 6 months of next year.
Do you feel that we've reached the peak for interest rates at this point?
Yeah, I think most people would say that we're way past the peak.
You don't think it's going to go back up? You think we're either going to be stagnant or maybe see some relief?
I mean, you never really know, because what you really want from your central bank is you want them to actually use reliable data to kind of figure things out. You don't want to see something happen like in Turkey, where the government was so adamant that lowering rates wasn't going to have a negative effect through inflation. And then, 6 Turkish lira to the dollar becomes, what was it when we were there over the summer?
40, almost
40 to the dollar.
Yeah.
And that you can almost pinpoint to their president, Erdogan, deciding to go against what the central bank was saying and keeping interest rates low for a long period of time. As you're evaluating investment opportunities, you're talking to folks like Viking, we don't ignore that as a risk. So I would never say interest rates are definitely going to go down, because you never know what's going to happen. And one of the things that has been the forefront of everybody's mind is what happens if inflation creeps back in. Now, if you use your eyes and common sense, you can kind of see that things are still elevated in price, but some of the things that really have a large impact on inflation, like housing, a lot of those, you look in some of the areas that Viking invests in, negative rent growth. When have you seen that in the last 10 years? Single family home prices in areas that got really overvalued, 100,000 every 2 weeks, prices dropping, asking prices, consistently. So I think that there is dramatic impact lowering inflation, but then you also have tariffs and the threat of tariffs. And we never know which threat is a real threat, which threat is a negotiation. So I don't think it's an easy job to figure out if there's going to be inflation or not. I think what most smart finance folks who rely on these markets to create returns for their investors, the big worry was always, are we going to get into a position that's going to be stagflationary?
Right.
And it doesn't look like to me that that's where we're headed. It looks like there's going to be enough growth catalyst to marry with some slight inflation. Maybe we don't get to the Fed's target, but between 2 and 3.5% inflation, I think is pretty solid. And maybe the tightening of the liquidity in the market should be loosened a little bit and kind of see what happens.
Yeah. So one thing I touched on, and you've kind of gone in and out of it a little bit, is the changes that we saw. You talk about tariffs and such, but that we saw with the big beautiful bill coming through. Multifamily had a really big perk because 100% depreciation was added back in. It was reinstated on, I think, on a permanent basis. And that alone, I think, was probably driving multifamily, not necessarily acquisitions, but at least investment. So based off of what you've seen since that has been reinstated, are you seeing optimism from investors, or there's still a lot of uncertainty? What are you seeing from their point of view?
No, I mean, this was a huge catalyst for people, at least smaller retail investors, to move off the sidelines and to start placing capital. People are excited. A lot of people, to my surprise, still don't understand the dynamics of bonus depreciation or how it works. So when people see 100% bonus depreciation, they think that every investment they make they're going to be able to write off 100% of that amount.
Right.
And I mean, in some cases that's true, but where I usually have a call that should have taken 15 minutes turn into an hour-long call is kind of explaining that it isn't smart to invest money into something if your primary goal is tax saving.
Right.
So it's great for that to be the ancillary byproduct, but I see folks putting their money in investment vehicles that pose higher risk to offset their taxes. And the reality is that when you use depreciation, you usually recapture it. So you're kicking the can down the road. And if you have a solid strategy, you can go decades without recapturing and paying that tax. And you just keep kicking the can down the road. But if you invest in something just to get bonus depreciation, but the group that you invested in loses your money, it kind of ruins that strategy.
Yeah,
So
absolutely.
what I would implore everyone that's excited about bonus depreciation is really to identify the risk, because the way bonus depreciation works is that 100% is the amount that you can depreciate on the asset. So if Viking buys a building for $80 million, 100% that we can accelerate into year one might be $18 million. And 100% just means that we can spread that entire $18 million amongst the equity.
Okay.
So in that same example, if we lever that property up to 90% and it's only 10 million of equity, we might give more than 100% of their investment amount in bonus depreciation. But if we only use 60% leverage and there's $30 million in the deal instead of 10 of equity, then you reduce it by, it's a third of that. It would be 33%. Now, a lot of people would be like, well, I'd rather invest in the one that's going to give me the larger depreciation. The reality is that's a much riskier deal. And almost every deal I've seen that gives you 100% or more of your investment amount usually comes with a higher level of risk that people are just ignoring.
Yeah. And I would say to anyone who's listening who might have just had the gaze going on, you've lost them. We had an episode that we did in Wealth Unfiltered last season where we had Brandon Hall on, who is an incredible CPA who really dives into this and the perks of it, but also the nuances and some of the myths. So I definitely recommend taking a look at that episode, and that will help you if you're interested in bonus depreciation. And we'll probably have Brandon on again this year because it was a powerful episode, and there was so much more we could have talked about, but we want to keep our episodes to a good time.
Yeah.
But I will say, I agree wholeheartedly, and I think that you're right. I think something that you noticed immediately was that all of a sudden people started deploying capital who were sitting on the sidelines. And I think that speaks a lot to the market feeling uncertain and maybe, okay, well, we have that uncertainty, but maybe there can be this silver lining of what I'm doing here.
Well, yeah, because that's a lot of multifamily investors that went through some adversity in 2021 and 2022. They were chasing depreciation because people weren't using the agencies. They were using debt funds and variable rate loans and using higher leverage, and it gave them huge amounts of depreciation. And a lot of those things didn't pan out. The investors got their hand burned. And then depreciation comes back to 100%, and now they're out looking for highly leveraged investment opportunities where they can get the most depreciation again. And I think if you don't learn from some of the mistakes, it's the definition of insanity.
I want to keep talking about multifamily, but I want to take a look back at some of the trends that you saw evolve and come forth over the summer. So anything that sticks out to you, multifamily related trends that happened that you'd like to speak to?
Yeah, I mean, I think commercial real estate has taken a really big step forward. Certain markets, even markets you wouldn't typically expect, like San Francisco, LA, New York, DC, really strong performance. And, they are like boom or bust markets. There are times where San Francisco is the leading market, and then a couple months later, it's the worst performing market, and there's landlord tenant issues in some of those areas. So we don't typically invest in those, but you're noticing that some of the areas that a year ago we wouldn't have really focused on, like certain parts of Atlanta, certain parts of Phoenix, certain parts of Texas. It looks as though the shortage of supply has done what we thought it would do, which we projected that in January at NMHC. Now you're kind of seeing it come to fruition. The absorption rates have been so high that you're actually seeing rent growth in areas where you actually saw negative rent growth in the middle to the end of last year.
Yeah. And it's not significant, but at least it's gone its way back up.
No, but when you have like negative, like for instance, correct. Like if you performed 5% rent growth and you got flat rent growth, then getting 1% rent growth this year isn't going to like massively change your ability to pay distributions for investors, but positive trends are positive trends.
Absolutely.
So, and the thing is that, when those are caused by absorption, it isn't like there's a giant wave of new supply coming online next year. For a new giant wave of supply coming online, you probably need to see interest rates significantly curtail down back into the threes or the threes, low fours. And even then, like getting it entitled, getting the process started, a lot of these units won't come online until 2028, 2029. So you have this window in time where you might have cap rate compression and you might have rent growth, and that's a recipe for a rebound.
Are you looking to build sustainable wealth and achieve financial freedom? Viking Capital can help you do just that through multifamily investing. With a team of seasoned real estate experts, Viking Capital conducts deep financial analysis and data-driven asset management to deliver outstanding returns. Their strategy focuses on low-risk opportunities with significant value-add potential, preserving your capital while maximizing long-term growth. Join them and be part of a success story. Viking Capital has acquired 30 properties and manages over 6,000 units, all thanks to their dedicated team and valued investors. Discover their current deal offerings at vikingmultifamily.com and start your journey to financial freedom today.
So what markets are you watching for the Q4 of 2025?
Yeah, we always love the Atlanta market, and it's been tumultuous. We have properties that aren't performing as well as we would have hoped. I mean, I think we're still very much outperforming the submarket, but I like different pockets of Atlanta. I like different pockets of Phoenix. I just love Arizona in general. The way that they do their property taxes out there is really beneficial to folks like Viking because they have maximum limits on property tax increases, whereas a lot of other states, it's like if you pay $20 million more than the next guy, you're resetting that property tax pretty high. You're not capped at 5%. So we love Arizona, and in my opinion, we've done a lot of retrospective kind of hindsight research at Viking to kind of figure out like what could we have changed? Like what can we build into our process now that's better than our process in 21 and 22? And through that research, we've noticed that a lot of the properties that we have that are facing adversity, and now that we see the trend line going up, there's going to be a window in time where we can buy more assets in those areas and really take advantage of how depressed the values are before they shoot back up, because we really still believe in the key fundamentals of those areas. So I think that's kind of our focus.
So for investors who are maybe dabbling or maybe still sitting on the sideline and are interested, and they're like, okay, I hear you, but what indicators would help them move the needle forward and say, yes, I want to invest? What should they be watching for right now?
So at a high level, and this is something that you'll see just reading CRE Daily or watching CNBC, we've already seen pretty major multifamily institutions making huge portfolio purchases. So when people say there's a bunch of dry powder, they don't mean that there's 200,000 retail investors that all want to invest 50,000. They're talking about the Blackstones, the KKRs of the world that have billions of dollars to invest, and they're waiting for the bid-ask spread between what people think their property's valued versus what it's actually valued today to come down and to get more reasonable. You pair that with interest rates, and you're going to start seeing big transactions. And those big transactions will be a signal to the rest of the market. And folks that are like Viking, folks that have been a little bit dormant. You see a lot of activity, and I think that is the core thesis that we're operating off of, is we have this window of time where if we can buy something close to or north of a 6 cap and we model it conservatively and there's cash flow, it's probably like 5 years from now, that's going to be unheard of. So get those deals. I think the time to act is now, because once it's obvious, then it'll be too late.
I think that's a really good point to make. And you said we're talking about, large acquisitions or, them coming in and buying several properties at once. And a lot of times in order for them to do that, they use fund structures. And what we've been seeing, I think one trend that was happening a ton over the summer is the dynamic shift of funds becoming more creative, funds happening more and more often, and totally different types of funds. There's everything from private equity and preferred funds. There's like the large scale, like let's just buy multiple acquisitions all at once. And so there's different ways that we're seeing them being structured. But what I'd like to touch on is how are retail investors currently, Viking has a fund currently. It's called Hyro GP, and it is a preferred equity vehicle, let's call it. And
Debt fund.
The debt fund. I would like to know, like, how are the retail investors and your investors alike responding to it? And, what is Viking doing differently to be creative?
Yeah, I mean, it's a complicated story with Hyro GP, because the reality of Hyro GP is it was really a capital call. So we structured it as a fund because when Vikram, Raya, and Ravi Gupta, our two principals, came to me and said, Chris, you have great ideas. Help us be creative and figure out what would be the best way for us to do a capital call on these properties that we could lose all of the equity on if we don't come up with a solution. What's the most equitable thing we can do for investors? I was like, I love this. Like, I will devote time to thinking through this. And what I came up with was a debt fund that we didn't pretend wasn't a capital call, where we went to all of the investors, and Viking essentially took, like, because you have these assets that face a lot of adversity that were structured maybe incorrectly. We can take accountability for that. And then you have like these other 8, 9 properties we've done since then that are just killing it. And this is actually an idea that came to me from an investor conversation. A small $50K investor called me up and was like, Chris, like, I'm in this property with you. It's the only one I've ever invested in. It's not performing, but I see your marketing materials launching all these other deals, and these other deals, the economics look better. I was like, well, that's not wrong. Like, you're right. Like, the basis on this deal is way better than the basis we got when cap rates were compressed. Now they're expanded. These are better deals. He's like, how does that help me? And it was kind of what made me think of doing Hyro GP the way we're doing it, which was Viking basically is going to leverage some of its future success to right the ship with mistakes that were made, whether it's through our structuring wrong or wrong timing, the market not being favorable. But we pledge 10% of the fee, the promote, and the dispo fee of like 8 deals to the fund. So that gives anyone that participates in the cash flow like insane cash flow numbers. They get 18% in year 1, 12% in year 2, 10% years thereafter. When these deals that have gotten extended and are probably going to sell in 2 to 3 years go out, they get their money back.
And how does that minimize the risk for them?
Well, what minimizes the risk is the other side of the Hyro GP fund. So you get the cash flow, and then that was one of the objections I had to solve for. Like, how do I solve from someone telling me that I don't want to put good money after bad? So I see capital calls happening all over the place.
That's a good point.
And and where the traditional capital calls usually land is, we're in trouble. This is either our fault or not our fault. Put in 20% of what you invested, and we will.
And you're just hoping.
And we're selling you some hopium.
Yeah.
Smoke it. And maybe things will get better, but if it does, it's either going to get better, or you're going to lose all your money, or you're going to lose all your money anyway, even the new money. So I wanted to avoid that because I knew that wasn't going to be something that was just a smart idea to do.
Yeah.
So the way that we did it was we leveraged these properties. So the bet Viking's making, because it's 10% pledge to Hyro GP, the other 90% of our promote and our dispo fee for all 8 of these properties is backstopping the fund. So $11 million in the fund, $35 million or $38 million of projected back end profits. Basically, Viking's profits for 2 entire years will go to pay that back. And then to make things even stronger, we started using this to protect and insure against loss of capital in the deals that we're taking on the capital call. So if people invested a certain amount of money, this $40 million of Viking's profits would go to make them whole. So it was a way for Vikram and Ravi to say, like, we're going to go to extraordinary lengths. We're going to pledge $7-8 million of Viking's profits to make this capital call work, and in a way where people will actually benefit from participating in it. We have so much confidence that we're going to turn these properties around that we're going to say the last 2 years of work that we did with deals that will perform, all of those profits will be wiped clean to make and protect everything else.
And you guys have this open to people who are not just investors in these deals, correct?
Correct. However, like the first 6 months of launching this was only as a capital call. So what I wanted to avoid was people thinking that we were just raising a debt fund and pretending we've never done a capital call.
Right.
And this is something that I've seen over the last 6 months is when someone gets creative, they want to then also be able to jump on a webinar and say, I've never done a capital call, when it'd be a lie if we did that.
Right.
This is a capital call.
Transparency, I think, is really key for people to understand that you're taking accountability, but then you're also doing everything you can to right the wrong.
And that's the key. And this is where I talked with Vic and Ravi, and I was like, look, guys, I was like, I think, like, I like my idea. I think it was genius. And I think it's fair. I think it's fair to the people that trusted us with their funds to come up with a solution to minimize the damage, even though everyone knew there was risk. This helps minimize the risk. But ultimately, the reason that I don't mind talking about it freely, I've talked about it on podcasts, I talk about it with new investors, is I think that it's important to show investors the lengths that you will go to as a sponsor when things get hard. We could easily just say, these are non-recourse loans, we're not going to extend them. You knew that there was risk, sorry, and move forward. And those 8 deals that perform and give us $40 million of profit, Vic and Ravi could take those. And technically, compliantly, they're not doing anything wrong. But that would have left a bad taste in everyone's mouth. And like Viking isn't trying to build investor relationships that only last through one deal cycle. We want people to know that, like, when we do well, like the early part of our track record where we exceeded expectations and sold in a compressing cap rate environment, that's how everyone felt it was good. Then we get to the part of cycle where all sponsors, not just Viking, are facing challenges. This is what you can expect from us. This is the type of company that we are when things get challenging. And ride with us to the next good part of the cycle, and you're going to be rewarded, knowing that we're going to protect you when things are tough.
And how are the investors taking it? Do you feel like they're on board?
Almost $7 million in funds that have come in have been from the people that are in those deals. And that's the testament. That's how you know that what you're doing is resonating, and
Absolutely.
people feel like you're building alignment within your trusted base. Because if they didn't use this as an opportunity for us to rebuild trust with them, then we would have raised $0. People wouldn't have participated.
And are you finding in today's current landscape, are investors prioritizing cash flow or appreciation, a combination? Like, what are you seeing as the major trend right now with what's going on?
I think it's a mix. You know, the reality is that cash flow isn't very abundant right now. So I think the people that are mandating that they get X amount of cash flow are probably investing in deals where cash flow is being generated artificially, which puts them at a higher risk. We try our best not to do that, but we do try to build in operational reserves that will allow us to smooth out cash flow early on in the deal. It's kind of like a bridge between the two because it's what people want. But it's never a smart idea to raise money to give back to people in the guise of cash flow.
Right.
So there's a
talking
limit.
about transparency.
There's a limit to how much smoothing is smoothing and how much smoothing is just, creating an attractive look and feel for something that may be riskier than on the surface.
So I wanted to touch on something that, we're talking about how the market cycle right now over the last few years has been pretty challenging. But Viking has actually stayed pretty active in this environment when there's a lot of sponsors that you're seeing are either closing their doors or are just staying sidelined. And that's institutional size as well as down to like Viking size or smaller. So what is Viking doing differently, or how are you guys finding capital when others are just not able to do so right now?
Yeah, I mean, it is precisely what we talked about. It's aligning with the investors. So accountability, showing up, answering the questions, not when things get challenging, not picking up the phone, and actually talking to the investors and explaining a lot of this stuff to them. The folks that invest with us might not be, 10 years in private equity and Wharton educated. They're smart people. So when you explain to them your thought process, you explain to them what's hurting some of the properties and how that very same adversity is creating opportunity, a lot of them, build that trust. Hire a GP. We created a class for folks that were in deals where we set expectations that weren't met, and they get a 90-10 split in our deals moving forward that would typically be reserved for an institution.
How are you guys finding new investors?
I mean, I think the majority of our new investors come from referrals, but our marketing department you're part of is incredible. So I think one of the big opportunities we found is we're operating in a market where everyone's faced adversity. Many of people have lost money, and I can't tell you how many investors who have seen the things we've done for our investors, like ask me if I will jump on a call with one of their other sponsors to explain to them how we're facing adversity, how we're communicating with investors, how we're building in contingency and making people whole.
And what about partnerships?
Yeah, I mean, we're one of the things that we put a lot of emphasis into last year, and we've really grown this year, is supporting groups of folks that are setting up funds or funds of funds to invest together to get better economics.
Okay, can you explain that a little more?
Yeah, so essentially, you always had this, I think a few years ago, you had this problem where folks that had networks that wanted to invest together, I think it started out as like an innocent idea, like say,
an innocent
idea
Okay.
that ended up in like kind of a tumultuous gray area and now has been like solved compliantly. It's like, say we go to all of our family and friends and we say, look, we're going to invest with this sponsor. And if we all put in 100K and we get to 500K or we get to $1 million, we're going to get much better economics than we would if we all invested individually.
Right.
So let's pool our money together and make one large investment. I think that was like the impetus. Like what it manifested and morphed into was people with networks raising capital, bringing large checks to sponsors, and wanting a fee, which isn't very compliant with broker-dealers rules.
Right.
So the gray area came in, like if you're going to be a co-GP, and this is like the languaging that people would rely on, you'd have to actually materially participate in the deal. So you'd have to manage your investor relations team. You'd have to so we entered into some of these relationships and, forcing people to materially participate in the deal, go to the property, do due diligence, be a part of DD, listen to the asset management calls, doing all this stuff. When in reality, what they wanted to do was
collect a check,
do investor relations.
Yeah.
And
one piece of it. Yeah.
So I connected with a group called TribeVest, and TribeVest was in a similar situation to Viking. They had set up a fintech company that was focused on supporting co-GPs. And then we're both like, we're putting all this effort into this, and this like, at the very least is in the gray area. And maybe like an argument could be made that this is incompliant. Like we can't change what was done in the past, but let's make sure that we come up with a solution. And I think Travis, the CEO at TribeVest, and I and his number 2, Brandon, and my number 2, Amir, kind of got together and they launched kind of a new system through their platform, which would support setting up a fund of a fund. They hired a securities attorney. They would make sure everything was compliant. And then I took on the challenge of helping people understand that if they did want to pool their capital together and they did want better economics and they wanted to learn how to be a fund manager, that we could help support them in that and they could grow and build their track record through Viking in a compliant way. And that has been really successful.
Yeah. And I think that we should ask them to come on the show this season because not only do you have a fantastic relationship with them, but there's probably a lot of listeners out there who are like, wow, I have a network who that would be really great. And I'd like to have, better returns. And I think that in order to do it compliantly, it is a really great, opportunity to work with TribeVest, but you really need to understand it. And there are, just like the bits and pieces of the partnership that every fund manager should understand first. So I know Travis said he would be, interested in doing it, but we should send out the invitation and get him on this season.
Yeah, absolutely. And I mean, Ashley and I are building kind of a training program for folks that want to do this because what I realized is I can't control what groups tell their investors. And it's very important to me that people talk about risk and people understand what they're investing in. Like that was, I think, one of the things that set Viking apart, especially while I've been there, is we're going to talk about all these things. You're going to understand how the model works. If you're not interested in learning how the mechanics of the deal work and what would have to happen for you to lose all your money, then you probably shouldn't invest in it. And I realized that in order to have these groups bringing capital to Viking deals where I never get to talk to the investor, that I was going to have to build expectations of what I wanted their investors to see and hear and understand before we would allow that fund to work with it.
Absolutely. And that gives you some such stronger alignment. So I think that was a really good idea. And I'm glad you and Ashley are working together on that.
Yeah.
So I want to wrap up with 2 final questions for you. So my first question is, in the next 90 days, what are your main focuses for your investment strategy?
Personal or through Viking?
You, Christopher Parinello.
Oh, yeah. I mean, I think that there is a ton of opportunity out there right now. I think that within real estate, I probably would shift a little bit more allocation to real estate than I normally would. I think traditional equities have shown to be resilient. So we saw what overheated looked like. We saw a little bit of a pullback. We're never going to completely divest from traditional equities. So there are targeted plays that I'm sure we're going to talk about in other episodes this year. So I think, being on the front end of that trend line, in the traditional equity space, I'd probably start leaning into some of the AI companies. I think most people are already doing this, but, maybe expand your allocation there. I think allocation to real estate with bonus depreciation, especially if you have rep status, is a given.
Yeah. And we're actually walking into tax season.
I think a lot of people are going to be focused on that. But really fine tuning the deals that you're looking at. Yeah, I mean, I think that those are the big ones for me.
Sure. And my final question for you is, what is one piece of advice that you would give investors who want to build wealth now in real estate?
What I would do is, as you're talking to sponsors, every sponsor, Viking included, have this discussion with me or my team, put them on the spot and make them talk about the deals that they did that didn't work and why.
Great advice.
There's no reason why everyone in the world shouldn't learn from the mistakes that real estate sponsors made over the last few years, because I know a lot of the sponsors in the space, the institutional ones, the mid-sized ones, the low-level ones, and I can tell you that from the very top to the very bottom, people right now are looking back and figuring out what they did wrong and how to build in processes around never letting that happen again. And I think if you're going to talk to 10 sponsors, compare what they tell you about the adversity they faced. I think that's going to give you a really solid education through learning from other people's mistakes. It's also going to tell you who's honest and who's not.
That's, I think, the best advice I've heard actually in a really long time. And I really, really appreciate your time. I feel like this was a very educational episode, and I love, kind of unpacking the summer. It was a little bit longer probably than our typical episode, but there was a lot to talk about. And I'm really grateful for your time. And I want to thank all of our listeners for joining us again in Wealth Unfiltered Season 2. We have so many fun guests coming up. So it's not going to be just Chris and I that you see. And we are forever thankful to you all for your time. So thank you. And you will see us again soon.
Thanks, everybody. Bye.
Bye. Thank you for tuning into this episode. We truly appreciate your support. Don't forget to subscribe, leave us a review, and share the podcast with your friends. Until next time.